The world's richest countries, from Norway to China, have built secret weapons of wealth. Not armies, not gold vaults, but giant sovereign wealth funds. Trillions of dollars invested quietly into companies, real estate, even sports teams. While you were scrolling through your feed, these funds were shaping the future of global power. Now, the United States, the largest economy on Earth, says it wants to join the game. Sounds bold, right? But here's the catch. America isn't Norway with oil riches or China with trade surpluses. The U.S. runs on debt, deficits, and political chaos. So how do you build a sovereign wealth fund when the treasury is already empty? Is this a genius move to secure America's future, or a dangerous gamble that could backfire on the entire global economy? Stay with me, because the answer isn't simple, and what you're about to discover may completely change how you see money, power, and America's place in the world.
America's big idea. Amid the flood of headlines last month, one story stood out quietly but carried huge implications. The United States announced its plan to create a sovereign wealth fund. Think of it as a government-owned super investment account. Instead of holding spare change, this fund would manage billions of dollars in public wealth, saving and investing it for the future. Globally, this isn't new. In fact, sovereign wealth funds are already among the most influential financial players in the world. Norway, China, France, and the oil-rich Gulf states have built enormous funds worth hundreds of billions, even trillions. They invest in global companies, real estate, infrastructure, and yes, even entire sports teams. The purpose? Stability. These funds create long-term revenue streams, insulating nations from economic shocks and resource dependency. On the surface, America following the same path sounds logical. But here's where it gets interesting. While other nations built their funds from natural resource surpluses or trade booms, America's finances look very different. And critics argue this makes the plan risky, maybe even unrealistic. But is it really a bad idea or just mistimed?
Traditionally, sovereign wealth funds are fueled by natural resource income. Countries cash in on oil, gas, or minerals, then set a portion aside for future generations. And here's the twist. The United States is now the largest oil producer in history. If there was ever a moment to start saving, it's today. And you don't need Norway's $2 trillion giant to make an impact. Scaled to America's massive economy, even a modest fund would become a serious player in global markets. But with that power come challenges. Would the fund stabilize the economy or distort it? Could it truly protect America's future, or would it simply fuel more political games? Before answering, we need to step back, because sovereign wealth funds didn't start with Wall Street. Their roots stretch back centuries, and their track record tells us a lot about what might happen if America joins the club. From grain silos to global giants, the concept of saving national wealth is ancient. For centuries, countries stockpiled grain reserves, gold or silver, to survive wars, droughts, and failed harvests. But the modern sovereign wealth fund was born in the 20th century. Kuwait's oil revenues set the stage, and soon other resource-rich nations followed. Fast forward to today, there are nearly 100 sovereign wealth funds worldwide. Collectively, they manage wealth equal to 10% of global GDP. Yet no two funds are alike. Some are brilliantly managed, others are misused or corrupted. Take Norway, the gold standard. Instead of letting oil revenues overheat their economy, they converted them into a globally diversified portfolio. This shields them from oil price crashes and prevents the dreaded Dutch disease, where oil wealth crowds out other industries. Contrast that with some Gulf states, where funds lack transparency. In many cases, they function less like public safety nets and more like royal piggy banks. And sovereign wealth funds aren't only about oil.
Australia, for instance, launched its future fund using proceeds from selling public companies. Every nation creates its fund differently, based on its priorities and resources.
The American dilemma. Unlike Norway or Kuwait, the U.S. doesn't capture much of its resource wealth. Oil in America belongs to private landowners or corporations, not the government. Instead of taxing profits heavily like Norway, Washington actually subsidizes the oil industry. Tax breaks worth billions are handed out each year. That means the U.S. government doesn't have the natural surpluses that usually fund sovereign wealth accounts. At the same time, America runs chronic budget deficits, spending far more than it earns. And traditionally, sovereign wealth funds require surpluses. On paper, America could still build one. Its advantage? Cheap credit. The U.S. can borrow money at some of the lowest rates in the world and reinvest it for higher returns. Sounds smart, right? But there's a catch. If markets crash, the debt remains. Suddenly, what looks like a wealth fund could become a massive liability. Instead of a sovereign wealth fund, America risks building a sovereign gamble. The scale trap. Scale is the biggest obstacle of all. Norway's $2 trillion fund looks massive, but their population is just 6 million. Spread across citizens, it's staggering. Now compare that with the United States, 330 million people. To move the needle, America's fund would need trillions. But deploying that much capital creates problems. Dumping huge amounts into global markets would distort prices, inflate asset bubbles, and possibly destabilize markets. Norway sidesteps this by avoiding investments at home. But for the U.S., that would be nearly impossible. Its own markets represent a giant share of global finance. Investing abroad sounds like a solution, but then comes geopolitics. How would other nations react to the U.S. government owning big chunks of their leading companies? The scale that makes America powerful also makes this idea deeply complicated. Why do it anyway? If the hurdles are so steep, why pursue it at all? 4 reasons stand out. First, geopolitics. China's fund is worth $1.3 trillion. For Washington, this is about rivalry and prestige. Second, bragging rights. Countries love to flex. Norway publishes its top holdings. China highlights its global reach. Qatar boasts of owning London's Shard and Harrods. The U.S. wants its own flex. Third, domestic politics. Saying, "We're investing for the people," sounds great on campaign trails. A sovereign wealth fund plays well with voters. Fourth, long-term projects. In theory, a fund could protect strategic investments beyond election cycles. But in reality, new administrations could still rewrite the rules. So yes, America may build one. But if it does, don't expect a trillion-dollar giant. Expect something smaller, symbolic, more political trophy than economic solution. The final verdict. Sovereign wealth funds are powerful tools. They stabilize economies, preserve resources, and create sustainable futures. But tools only work when used at the right time. And right now, America's economy doesn't need a hammer. It needs a scalpel. If the U.S. does move forward, the fund will likely be modest. Maybe a few strategic investments, maybe a political headline, enough to say it happened, but not enough to transform the nation's finances. A sovereign wealth fund could still work one day, but today, in America's current fiscal reality, it's less a strategy for stability and more a symbolic experiment.